So we got lots of talk about. We're going to cover some stats, interesting stuff going on with inventory and prices. There have been some movements on interest rates. There has been some interest on insurance. Here in the Denver metro area, we are actually down negative 2.5% from September 23 to September 24. Inventory continues to keep building, and we did cross over the 11,000 unit mark. And the last time we've been this high was actually back in 2012. And I believe this is the first time in a long, long time that we've crossed over that 3-month mark. Now, typically as you cross over that 3-month mark, that's an indicator saying we're starting to reach a balanced market. What's up, Colorado real estate investors? Chris Lopez here, along with the gang, to come talk about the September updates, September stats and trends that we're seeing in Denver and Colorado Springs. So I have got Jenny Bayless with me down south. Good afternoon, Jenny. Always good to have you
Chris.
back.
Yeah, thanks for having me.
Got Jeff White here in Denver, who's the investor and agent up here in Denver, representing us. What's up, Jeff?
Living the dream. How's it going, Chris?
Love it. Last but not least is Troy Howell, our amazing lender, who has to be in Denver as well, but does loans all across Colorado. Good to have you back, Troy.
Good to be here, Chris. Thanks for having me.
So we got lots of talk about. We're going to cover some stats, interesting stuff going on with inventory and prices. There have been some movements on interest rates. There have been some interest on insurance. And then we're also going to talk about a deal or two and also some interesting news articles that we have come across. But Jenny, we always like to start with stats. So give us the punchline of what's going on down there in Colorado Springs in terms of like price and inventory.
Yeah, so the median sales price went down 1% month over month from August to September, but it's still up 2% year over year. So we're just kind of hanging steady. You know, I think we typically spout 3 as being average appreciation rate in real estate. So we're just a little bit below the average this year, which is not too bad considering all the kind of uncertainty that's been going on in the market. So pretty stable, I would say, to that end. And then in terms of active, we are up 36% year over year, but we're only up 2% month over month for a grand total of just shy of 3,400 units for single family homes. So, it's not a lot of active units. So any like small change will look larger percentage wise. So just kind of keep that in mind. But yeah, it's pretty, it's mirroring what we typically see at this point going into the fall seasonality piece of it.
Well, we are not seeing the typical seasonality stuff up here in Denver. I have a very interesting stat to share. I want to get everyone's take on here because I think there's a few angles to cover it. So when we look at year over year prices, and Jenny was just saying you guys are just up under 3% Colorado Springs. Well, here in the Denver metro area, and this is for the Denver or DMAR stats from last month, we are actually down negative 2.5% from September 23 to September 24, which is the surprising one there, because typically we're down a little bit August to September and then slightly up year over year. However, we're actually down about negative 2.5% when we look at the year over year. So that really surprised me. And so I did some asking around, did some digging in. And then one of the conversations I had was with Lonnie Glessner, who does he's a stats guy, and he was surprised by the stat as well. And he had 2 really interesting comments on there. One is he goes, "Hey, look, it's not a trend until we've seen 3 months of prices going down." He's like, "Look, I don't think anyone should be like saying, oh, the market's crashing." But as someone on his team or one of the groups he's with, they dug into stats a lot more. He thinks it's more of a unit price mixture difference versus actually prices dropping. I forget the exact numbers he said, but he said houses in like the $400,000 to $600,000 price range were up like 4% and change. And so houses above the $700,000 mark were down like 1% and change. So his thought was that, hey, it's not really prices dropping. It's more so that we end up selling a lot less expensive homes, or, we sold fewer expensive homes, but we sold quite a bit more of, cheaper homes in that $400,000 to $600,000 range. So I'm going to pause here because I'm kind of curious if you guys got any thoughts or feedback on there, or Jeff or Troy, if you guys were surprised by that stat.
Yeah, actually, I was going to say something similar. I was thinking it was some type of, because the median, it's a great metric because it's like the middle number of a data set. But the problem is also, well, what happens if, the luxury type real estate doesn't sell as much and then all the lower price stuff sells more? Then obviously it's going to drag the price down, but it doesn't mean the market, like we're experiencing any type of crash or market correction per se. It's just like a specific time. And, it'd be interesting to see if the trend continues for like another, like this time next year, if we still see a decline, then it can tell a different story. But that doesn't really, I kind of agree with that person you talked to. It's probably something of how you calculate the median, and the higher end stuff's not selling versus the low end stuff is definitely selling way more than before.
Troy, you got any thoughts on that?
I agree with that. I think there's just those micro markets as well, but that price point, there's definitely more available buyers for that lower price point. So I'm in agreement with the folks you've talked to, Chris, that I think those lower price points are still going to get good demand. The higher stuff, a bit higher to qualify for, bigger hit, obviously, from a payment standpoint, with what the market's done on the interest rate side that we'll get into here.
Yeah, but I wanted to share this graph because I think this is an interesting graph to look at. So this is the 10-year view of the residential median and average close prices. That light green is average, that darker green is the median one. But you can see here, I'll zoom in quite a bit. This is August, and then we go to September. It is quite a steep drop, which is that, negative 2.5 we're seeing. And I mean, that almost looks very similar to what we saw about 2 years ago once interest rates started going up, where it was a very dramatic drop. Now, I think this is more, like I said, a blip due to this kind of like statistical mixture of things. I think prices aren't going to continue dropping, and they might actually kind of, so to speak, rebound some. But it'll be interesting to see what the overall unit mix sells, or the unit mix of sales prices are for the rest of the year. So no one panic. No one think the market's crashing. That's where I'm placing kind of my 2 cents in here. But on that note, if anyone's out there looking to buy a property, we've said this, I think, every single month for a long time, but get your butt in gear for November and December. The market is soft right now, and it's also historically, from a seasonality standpoint, the best time to buy properties is in Q4, especially November, December timeframe as holidays happen. And of course, we start having, not nice weather where people don't want to go out there and deal with showings and looking at properties. The other stat I wanted to talk about was active inventory on here. So this is active inventory for what we're seeing here in Denver. So this green line is active listings on here. So you can see starting right around, I think it was like in May or June this year, we started to see the inventory creep up, which is normal. And then in like June or July, we saw that like 30-40% increase year over year in inventory. Now, year over year, we're seeing the same like 40-some% increase. Last month, this month, we're seeing like 2 or 3%, which is pretty typical. But you can see here, inventory continues to keep building, and we did cross over the 11,000 unit mark. And the last time we've been this high was actually back in about sometime in 2012. Now, the other threshold we crossed over is we actually got over 3 months of inventory. So basically saying, hey, if we have 11,000 properties on the market and 3,500 properties are being bought per month, if no new inventory came online, how long would it take for all those properties to be purchased? And I think right around like 3.5 or 3.6 months of inventory. And I believe this is the first time in a long, long time that we've crossed over that 3-month mark. Now, typically, as you cross over that 3-month mark, that's a kind of like an indicator saying we're starting to reach a balanced market, meaning that sellers nor buyers have a strong advantage in it. So, I mean, from an overall market health standpoint, it's really good to see us coming back into more of a balanced market. And we're getting out of all the crazy COVID days and then getting out of all the, even the less crazy days that happened before COVID. But inventory has now gone past the 3-month mark, which I found really interesting, and also a great sign for like overall market health.
Yeah, Chris, I had a question. With your first stat, what was the difference in closed units month over month?
The difference in closed units? Let me pull it up because I don't know off the top of my head here. So I'm going to just going back to sharing my screen here.
I was just thinking if it was significantly less,
I don't think it was. I mean, so closed year over year, we're down about 9% in our close. So last year, we closed about 3,400 in September, and this September, about 3,100.
Okay.
You got any insight on that data, like on how that would impact it, or any thoughts on there?
I mean, I would assume that if there was significantly fewer closings, then each closing would have a more dramatic impact on the median price or the average price or whichever version you're looking at. But it doesn't seem like, a significant change on that end.
No, it doesn't. The other thing to look at, since we're talking about this, is like the close price to list price ratio, which is, hey, on average, what did a property sell for based off of the final list price in the MLS? So last year is at 99.2%, or last September. This September, it was at 98.9%. So just down about a quarter of a point in terms of like close price to list price ratio. And so, I mean, you would think it would be a lot higher based on how much the prices dropped. So we'll just see over the next couple of months how everything settles out. But if you're looking to buy this quarter. If you're looking to sell, hopefully sell in the springtime. That's the theme that has not changed. Troy, talking about some other really cool, interesting indicators. Interest rates went had a little roller coaster here the last 6 weeks, 8 weeks. Remember, the Fed dropped the federal funds rate by about 50 bips or 0.5%. Yeah, give some commentary on this.
Yeah, it's been a little bit of a point of conversation with a lot of folks because ever since they cut 50 basis points on September 18th, the 10-year Treasury has steadily risen it was at 3.68, and now we're seeing about 4.23. So more than 0.5% increase in the 10-year Treasury. And some of the economists, what they're talking about with respect to that is the investors, and we're talking about the investors that buy 10-year Treasuries and buy mortgage-backed securities, which obviously influences their pricing, feel that since that cut, that's better for stocks than the bonds. And so they're increasing their hope that there's going to be a soft economic landing, not a recession. And maybe the point of feeling that there may be no landing at all. So that's some of the sentiment that's out there. And then there's still some inflationary fears floating around. Definitely from a world economic standpoint, China's been doing some different things. And we've got to understand that the investors that buy treasuries and mortgage-backed securities, it's an international thing too. It's not just domestic. So what goes on in the world will have influences on our interest rates, crazy enough. And so, yeah, it's kind of the reverse of what everybody was hoping for and anticipating, but we're still not the worst it's been by a good amount. And there's still deals to be had. Like Jeff and I have been talking. You can still create deals, make deals. Like you're talking November, December, still a great time to buy. You can build your deal, and don't let the rates one of those numbers when you're doing these house hacks. It's not the begin all end all.
And so the important thing to keep in mind, I mean, to really iterate to people is that, mortgage rates are not directly correlated to what the Fed does. That is more as Troy saying the bond market. And when the market thinks the Fed's going to cut by a quarter point or half a point, when the day comes and they actually cut the rate, if it happens what everyone expected, that's already baked in. Like the banks and the market don't wait around for Jerome Powell to say, hey, we dropped today. Like, if we think that, it's already baked in, weeks to months in advance. But if it doesn't go as planned, then you'll see, them jump after that.
Yeah.
And we were talking because you mentioned, you and Jeff. So I'm going to move over to like actually how you guys use this to one of your clients' advantage. Because I think you guys had someone under contract, rates started creeping up. And then Jeff, you negotiated some stellar seller credits. Can you talk about the deal and give the commentary on there?
Yeah. So it was a investor who bought a duplex from a wholesaler and all cash, fixed it up a little bit, just more cosmetic stuff like paint and flooring, new appliances, new countertops, nothing too crazy, but just a basic side-by-side duplex in Nevada, 3-bed, 1-bath each side for $655. And what I always tell my clients, especially this time of year when it's the fall, it's like, ask for more than you expect. And what's the worst they're going to you see the numbers, like the active inventory is way up. They don't want to wait 3 months to sell or longer. They want to sell it as soon as possible. So ask for more than you expect. And then what's going to happen is they'll probably most likely counter you. It might not be exactly what you want, but it might be 50% of what you kind of were shooting for, or 75%. And then that's kind of like the story on this one. It was listed at $655. It was on the market for about 30 plus days. They just did a price reduction of $25K. And then we started out just aggressive. We asked for, I believe the initial offer had like a $13K seller credit. And then through the inspection, we got additional, we said, don't fix anything, just give us more seller credits. We got the whole total seller credit for a $655,000 move-in ready side-by-side duplex in Nevada, $18,000. And with that, now Troy can work his magic, all his underwriters back there pushing papers, can work the magic to bring it down the rate. And what was the rate he locked in at, Troy?
6% on his deal.
Yeah, for a duplex.
Which we caught it at a great time before this started creeping up on us. But yeah, it makes his numbers work really well.
Yep.
How much of a buy down did he, or how much of a rate did he buy down?
That is a great question that I can answer for you. So we spent just about $10K to buy that rate.
What was the rate at before it got bought down to 6?
Oh, it might have been more mid to upper sixes. More like a 6.5, 6.65.
Okay, so this is a significant reduction for $10,000. That's great.
Yeah, it's well spent money, and then the rest of the money goes towards the basic closing costs. So his all in on this property is going to be under $35,000. That's down payment, closing cost, have that rate. And then there's some pretty good numbers on there, right, Jeff, for what the rental is going to look like.
Yeah.
Well, before you get into the numbers, Jeff, I know you said $35,000 all at the closing table. What's the estimated repair cost for anything that needs repair?
Yeah, the inspection, most of the stuff was just like normal wear and tear for an older 1960s duplex. Like the furnaces, like the big ticket items, roof was brand new, windows are new. It was brick, so that was solid. Had some, those like little cracks around the windows, but they actually did foundation repairs back in the day. So that was nice to see. And we had documentation of that. And then the rest of it, new appliances, it was pretty much, to answer that, I would say 5 to 10K, probably all in. And most of that's probably furnishings, if like for their side. Not much big ticket items to worry about. Water heaters are all brand new. Furnaces are 10 to 15 years old. No AC units, but the big ticket items are taken care of, and they just have to worry about the small stuff. And the electrical panels are new too. Yeah. So 5 to 10K all in, probably on top of that 35. And yeah, and they'll build and then you want me to go to the numbers, Chris, or you want me to just walk in there?
Oh, no. Go on the numbers. I was just curious about, So walk in the numbers there and.
Yeah. So he'll take one side and then rent out the other side, $2,900 for one side, 3-bedroom unit over there. And his side, I don't know if he's going to do rent by room or just take the whole unit place, but assuming he takes the whole unit, just himself, no roommates, he'll collect $2,900. And then what was the mortgage, Troy? Like 40?
It's with taxes all in, insurance, he's $4,463 3, so under $4,500.
So he'll probably be all in, holding back for, like capital, maintenance vacancies, CapEx, probably around 1,800 or so negative in there for his own 3-bedroom unit. And to give you a point of reference, he's coming from Seattle paying $2,700 for a 2-bedroom over there.
Two-bed.
So it's a net savings for him.
Wow. That is amazing. So he's got to be pretty pumped about that, I imagine.
Yeah. First time house hacker and getting on the property ladder, and he's very excited. And it's a great property to start with too, like just ready to go. You could just move in tomorrow, and it's vacant too on top of that.
Nice.
So he can put his own renter in there, which is nice.
You said both sides are vacant?
Yep.
Okay. So Jenny, I know you don't have a deal to talk about this month, but you said you had an interesting news article that you wanted to share.
Yeah, it caught my eye. It was titled, it was published yesterday, which was October 23rd. And the title is, "What Does a 32% Vacancy Rate for Downtown Colorado Springs Mean for the Economy?" Written by Emily Coffey. So there's kind of basically 2 groups that are, interviewed and cited within the article. One group called Integrity Matters sent out a press release saying that there is a 34% vacancy rate in downtown Colorado Springs, to which they mentioned it was alarming and said that it signaled overbuilding. And then kind of the opposing group.
Was this office or multifamily?
Multifamily. Mm-hmm. And then the opposing group, the Pikes Peak Housing Network, which my understanding, they focus on affordable housing initiatives for the city, was quoted saying, "To suggest that we should stop building is really not just erroneous. It could really harm Colorado Springs." So there's really kind of 2 very opposing views on, the adding of new apartment units downtown. And it's interesting because I know Chris and we've had this discussion fairly recently about something that you were looking into. And I kind of gave you my thoughts on the downtown situation with, the apartment building and everything. So kind of historically, they're looking at a couple of new build buildings that were put into, put to market the end of 2023. And I guess they said that they did have a huge vacancy rate at the end of 2023. But then by the end of the year, all the housing was occupied and absorbed. So it's just kind of that really interesting, like, what is kind of the threshold here before you do have that oversupply issue? And then they kind of go into something that, Chris, I know I've expressed my little bit of concern on, is the affordability piece of it. And that the price point of these new build apartments are, in my opinion, quite high and don't really match with what the average citizen in Colorado Springs, takes home and would be able to comfortably pay. So that was kind of cited in the article as well. So it's just kind of interesting that the 2 viewpoints were mentioned. There's really no clear-cut answer to what's going to happen to the existing buildings that are coming online. That 32% vacancy that's current, is it going to get filled by the end of the year? Will it get absorbed? That whole mix of price and availability too. So it's really kind of interesting to see how that's going to play out. And I think that will have a pretty large impact on new build construction in Colorado Springs downtown area going forward.
Yeah. And so is that 32%, was that sampled from all the properties or a few properties?
It seemed like they cited 2 major apartment buildings, the Fiona and the Experience at Epicenter, which I own that single family home that I was mentioning right by the Experience. So that's kind of why I kind of keep a pulse on this particular area. So.
Yeah. Can you send an article over? I want to read it. Then we'll post it in the show notes as well.
Yeah, absolutely. It's really interesting. And I think both groups cite very valid points, and it's just really going to be a matter of how does it shake out? No one knows. And it would be curious. I hope they do a follow-up article at the end of the year, but I'll definitely send it over to you.
Yeah. Do you know what for all the apartments, like what the vacancy rate is?
No. Mm-mm.
Okay. Because I've seen other numbers earlier this year, and they were nowhere near like 30% for the markets. That's really interesting to read into.
Yeah. And I think they just came online like, I don't know, a month or so ago. So you assume the buildings would have 100% vacancy. So it's just a matter of how fast can they get filled, and what is the price point of these buildings that people can no longer, they can't afford to fill them. And then, they're generally owned by large owners. So are they going to sit on the vacancy until they can get the price that they want because they can, or are they going to start lowering prices? And then kind of how does that impact, the surrounding apartments? So yeah, I'd be very curious to see how this plays out, and what other large apartment building developers do, while they're watching this.
Yeah, well, keep us in the loop as you see those articles and any other data around. That's really interesting.
Mm-hmm. Yeah.
So something I wanted to talk about was insurance. So this is the first time I've seen a dramatic drop in insurance. So not an increase, but a dramatic drop. Now I want to pull up my exact numbers here. So this is for an apartment building I'm a very small investor in, but it's in Arvada, and it's like 200 plus units. So they just had their insurance drop by about 30%. So the per unit insurance dropped from $1,100 per unit to about $750 per unit. Now, of course, last year, like most, landlords and property owners, they had the dramatic increase. But this, I've been hearing, people talking about the insurance market stabilizing, and I got this in like quarterly report from the investment I was in, and they saw a 30% drop in their insurance rate. Now, of course, they were shopping around and, doing all the stuff to go out there and, get the rate lowered, but a 30% drop, which was a nice surprise.
Did they change carriers?
I believe so.
Okay.
I don't know the exact details on there, but they have, they have an asset manager for that. And, his job is go out there and, free up every dollar expense they can. But this is what's interesting. It's a big apartment building, I think it's close to like a $70 million value. And assuming it sells at around a 5% cap rate, that drop in insurance, it has a $2 million price swing because expenses dropped. So NOI increased. And of course, NOI is a main factor for, valuation on commercial properties. But that insurance should create about $2 more million in value in that building, which I knew things were stabilizing, but to see it drop that big was nice. And Troy, I'm curious, again, this is commercial, and this happened a couple months ago. But Troy, I know you see, not just the deals you do with Jeff and all this Envision, but you do a lot of deals with a lot of, agents and people all over Colorado. Have you started seeing any like patterns or notice anything on like all the insurance stuff that you look at from your end? Any trends or leveling off or drops?
Yeah, I think the one that really jumps out at me here recently that Jeff and I are working on is a gentleman to be talked about more in the future, but buying a fourplex and shopped around, and the quotes were wildly all over the place. And a good source that we work with came through really strong. But he had a quote on this $820,000 fourplex as much as $10,000 a year for the homeowners insurance. And they were trying to write it more as a commercial deal, I think, is what was really screwing up. But then he had another quote for $7,000 and change. And ultimately we came through and got the winning quote for like just under $3,400 a year. So that's a wild, from half to 3 times as much potentially to where he's at, which is more in line with what I would expect. I think there's definitely been some stabilization. I don't know if I've necessarily seen a decrease, but shopping it out and being diligent with that, and then using some of our resources that Jeff and I have really came through strong for him.
Do you guys know what is causing the decrease in premium cost? Or
in our particular situation, it was more related to how they wrote it and looked at the property and going through the right carrier.
So what I've read in a couple different articles off and on this year, just talking about insurance premium rate cycles, is that, we've had the increase in insurance costs from all the, the crazy weather we've had and everything like that. And so like most things, when you have like a free market, hey, prices go up. So some carriers start leaving, some carriers start raising premiums, which causes the prices come up. But then when premiums come up, that gets other carriers to come on board or to come in the market, which helps to, lower the price. And then also a lot of the factors that cause insurance to spike has now, softened up. Because, law of averages, we had really low insurance for a long time. So I think a lot was just also the other points, just law of averages kicked in. Oh, hey, insurance has not been really increasing much. And rather than being gradual, it was, ripping off the Band-Aid and a big jump up. But I've read that from articles in Colorado, and then a few deals I've looked at, I haven't invested in, but a few deals in like Florida where they are very sensitive to, weather and insurance events. And it's just been very interesting to see that.
I guess I have to call my insurance broker after this.
Yes. Why was that? Because I think it's in May, that's when pretty much all my policies renew. And so I usually reshop it, right around in April. And all my premiums drop by overall like a couple percent without any
That's
big
great.
policy changes. Maybe there was some slight increase in deductible payment, but nothing significant. So I was like really happy that I'm knocking on wood now because I probably just jinxed myself. That overall, like my insurance actually dropped slightly, which I was like, you sure about that? Okay, just lock it in. Let me pay it, lock it in. Yeah, so it's a good reminder here for anyone that's had big insurance increases. Definitely go out there and reshop the insurance because, if a big multifamily building like that saw a 30% drop, and I think that's more on the side that's not typical, but hey, if they did it, doesn't mean that one of us can't do it. So definitely worth shopping around. And I'm always a big fan of working with insurance brokers versus people that work with one insurance company. So if you're working with one insurance company, great, get it requoted, but also go talk to other insurance companies as well and get multiple quotes to go out there. And especially if you have a broker that knows rental properties, they often know how to structure the policies correctly to make sure you have the right coverage and also, can get better coverage and better rates than somebody who's not familiar with rental properties. So please, please, please talk with an insurance broker that actually knows rental properties. And if you need any recommendations, we all have great recommendations. So reach out to any of us. I still use the one that Jenny recommended to me years ago. And, Bill and Kathy are great brokers.
Yep. Definitely don't skimp on insurance.
Yes.
That's my 2 cents on that.
And then speaking on this is, you made me think when you said that, some article I saw in one of the local newspapers, I think it was in Parker, in a newer development, but they had, a bunch of rain, one of the big rainstorms this year, and, a lot of rain, and the system they had and layout for getting rid of water was not working like it should. And so their basement got flooded. And especially since we've seen some crazy hurricanes in Florida this year, and over the last couple of years, there's always some crazy storm in Boulder or crazy storm in Parker. Always go out there too and check out the FEMA flood maps. They change. See if you're in a flood zone now, see whatever. And if you have any potential need for flood insurance, make sure you get that, because when that stuff happens, your homeowner's policy typically does not cover it. So I agree with Jenny. Do not skimp and measure twice. And
also speak with grading professionals. I unfortunately had to spend, 5 figures last year on doing a couple of properties, needing to install a French drain on one, a drain with a sump pump on another, because the rain from that we got last year definitely called attention to the issue that it was just kind of a, you don't know it. You don't know you need it until it happens. And, we might not have rains like that again, but one more rain like that and those properties would have been severely damaged. So, make sure you look into that too. So I think that's everything on the agenda I had written on my notes here. Jenny, Jeff, Troy, any final closing thoughts, talking points, any data points that we skipped over?
Final thoughts, I would say, Don't look at negative headlines as a negative if you're either on the buy side or sell side. Sometimes it's just market timing. You have to remember a lot of the negative headlines just sell clicks and papers and articles and stuff like that. But don't be afraid in this market. Fear is some of those things people get too wound up in, whether it's election cycle or negative headlines. If you're a buyer in this market, whether you're doing house hack, normal purchase, or investor, fall, winter is the best time for the buy side. On the flip side, if you're trying to sell, definitely look more spring, summer. That's definitely, it's switched for that. But yeah, fear and uncertainty, that's definitely part of any market. It's never a good time to just, it's always been hard to buy stuff. But don't look at it like I have to wait for the right time, or I'm wait till the rates drop to 5%, because what if that takes 5 years to happen? You're still waiting. So yeah, fall, winter, make a decision. Purchasing is the best time and you get the best deal.
Those are great points, Jeff. And I think ever since I've known you've got one of like the opportunistic and how do I make it work mindset. I think you are great at training your mind that way. And I think that's a great reminder for everyone out there, and us included, to go out there and where is the opportunity? How can we make it work type attitude? So awesome. Well, another great monthly recap, guys. We'll be back next month. We'll have some more deals. We'll keep you up to date on some vacancy in Colorado Springs. I'm interested to see what Denver prices do. And of course, any other commentary coming on in the market. So Jenny, thank you. Troy, thank you. Jeff, thank you. If we're out there, if we can help you or, give you some knowledge, definitely reach out to all of us. We always love talking strategies, and most importantly, we love doing deals. So thank you so much. Bye, everyone.
Bye.
Thanks, guys.